Thank you so much for being here with us tonight, and thank you to those of you who've joined us on the call. We're really excited to hear from Rhonda McIllwain, Geoff Close, and Beth Mizell. This is Leaving a Legacy, and I am Anna Pachias. I'm the Director of Leadership Giving at the Shenandoah National Park Trust, which I know you all know is the philanthropic partner for the Shenandoah National Park Trust. We fund a variety of projects and programs in the park, and our mission is to invest in initiatives that protect, enhance, and preserve Shenandoah's resources, not just today, but for future generations. So that may include youth programs and initiatives, trail maintenance, bear boxes. There are all kinds of ways that we enact that mission in the park. And these are the kinds of things that Shenandoah could not afford on its own. So we're proud to be able to contribute in that way. And we're grateful to our donors because we wouldn't be able to do this work without them. So tonight's webinar is inspired by our donors. We have quite a few people who give in many different ways and very generously. They give monetary gifts, gifts of stock, they give in-kind gifts, and they give donations of land, which you'll hear about more later. And many of our supporters are reaching out to let us know that they have left the Shenandoah National Park Trust in their will, and that we will be the beneficiary and they will leave a legacy behind. So this is the Legacy Society, and it's growing every day, I'm excited to say. And so we thought we would have this program both to inform people who are thinking about joining the Legacy Society and also just to show how it's growing and how you can make an impact in this way. So there are 3 goals tonight. We're going to learn about the different ways to give to the trust while also meeting your financial goals and safeguarding your family. We're going to learn how to use land donations in creative and tax-smart ways that will support the trust and benefit the park at the same time. And goal number 3 is we're going to learn about the trust's newly launched Good Neighbors program, which is working to increase land conservation along the boundary. That's 800 miles of Shenandoah's boundary, and also to learn how gifts of land work. And they can benefit you and they benefit the park. So I'm excited to introduce our first guest, Rhonda McIllwain. Rhonda worked as a trust and estates paralegal at Womble, Carlisle, Sandridge, and Rice in Winston-Salem, North Carolina, prior to becoming the Assistant Director of Gift Planning at the University of Richmond. Rhonda is now retired, but we are constantly hitting her up for advice and guidance because she has extensive experience administering trusts and estates and helping donors make charitable gifts. And so she will be somebody who we will bring back again and again. And tonight, I know, Rhonda, you can talk for hours about these topics. And lest we nerd out, you and I decided on a Q&A format. So I will ask you questions, and listeners, there will be a chance to ask Rhonda questions all the way at the end of the program. So welcome, Rhonda. How are you?
I'm great, and thank you. And thanks to everybody who's interested in this wonderful topic about legacy giving.
Wonderful. Well, my first question is, can you give us an overview, a working definition of gift planning, and what does it mean? We hear that term a lot.
Yes, gift planning, planned giving is simply the act of making a charitable gift at a future point in time. And so many philanthropic people, myself included, can make larger, more significant gifts if they make them on a deferred basis or through their estate plan.
Well, that is super clear and super helpful. So now my next question is who? Who should be thinking about a planned gift? At what age and stage of life should a person be talking about these things and thinking about these things?
That's a great question. Anybody who starts accumulating assets. I had a very young colleague that I worked with at the University of Richmond. She was under the age of 25, and she wanted to be one of the charter associate members of the university who were making a gift through their estate plan to benefit the university. And she said, how can I do it? I said, well, you earn a paycheck. You now contribute to a retirement plan. And I said, the easiest thing to do is to designate the university as a beneficiary of your 403B plan. And that's what she did. So in answer to your question, anybody at any age should start thinking about how they want their assets distributed when they pass away.
I love that example because it's somebody who's at the beginning of their career and they're
Exactly.
already thinking about their legacy. So that's a beautiful example. Thank you for sharing that. So
Yep.
now I'd love for you to give us the top 4 or 5 most common, most popular, and easy to use gift planning vehicles. What are the most common ways that people can give a planned gift to an organization like the Trust?
Certainly. Probably the most prevalent, the most one that we do and hear about all the time is a bequest through a will or a trust. And basically making a bequest is simply stating that I want to give a set amount of money or property or a percentage of my estate to a charity, an individual, or an organization. And this is done through an individual's will or trust. It does require an attorney to finalize that designation. And that's probably the most common gift planning vehicle. Second would be beneficiary designation of things like insurance policies, retirement plans, IRAs, also brokerage accounts, where you would simply fill out and submit a beneficiary designation form, and that where you can state who you want, who the beneficiary is, or beneficiaries of your asset to go upon your death. And that does not require an attorney. That is probably less prevalent, but a simpler way of making a planned gift. Another vehicle that we gift planners love to talk about are charitable gift annuities, which are a much more complex topic, but they are a tremendous a charitable gift annuity is a contract that between the donor and the charity, where the donor has given in exchange for a charitable gift, they get a specified income stream for their lifetime. And Jeff, I think, will use an example of that later on when he's giving an example of one of his planned gifts. But charitable gift annuities are wonderful instruments that benefit both donors as well as the charities, but they're a little bit more complex and require a little bit more discussion. Another planned gift vehicle that I do want to mention are qualified charitable distributions, which allows a individual at the age of 70 to distribute funds directly from their IRA to a qualified charity. And I'll talk a little bit about that after down the road a little bit, because it's something that I think everybody should be aware of who want to make charitable gifts and are of the age that they have retirement assets that they can draw from without a penalty. And so we'll talk about those.
And when we do, you'll also mention what the benefits are, because there are
Exactly.
benefits not just to the charity, but to the person themselves.
Very, very definite
Right,
benefits.
right.
Yes.
And I know you wanted to add to that list donated land. However, we're going to put a pin in that because both Jeff and Beth are going to talk about land donations.
Absolutely. Yep.
Yeah. But that is another one that we can add to the list of ways, perhaps not as common as some of the other ones that you mentioned.
But very important ones, because you said, as you mentioned, some people have more land, more real estate that they don't know really what they want to do with, and it can definitely benefit charities like the Shenandoah Trust.
That's
It
great.
absolutely can.
Yeah, and we're going to learn more about that. Now, I
Hmm.
will say you brought up qualified charitable distributions, QCDs. I know as a
Hmm.
fundraiser that those are becoming more popular. We hear that word a lot, but there are people who are confused about the difference between QCDs and RMDs, required minimum distribution. I know they're closely related. I also know they're different things, and I know you can walk us through and help us differentiate.
Absolutely. And that's why I didn't go into any detail about qualified charitable distributions, because I did want to make the distinction between those two. One is a vehicle and the other is a federal regulation. So a qualified charitable distribution are enables an individual to take funds directly from a traditional IRA. They have to be at the age, they have to be 70 years old though, in order to do this. And they can take funds directly from their IRA and send the funds directly to a qualified charity. And the benefit of doing this is that they do not pay taxes on that distribution. So they're allowed to take funds, take assets from their IRA and take it out and give it to an organization that can really use the asset, and they don't have to pay taxes on it. So that's a huge issue. And I'll give you an example of a required minimum distribution and how you can use it as a qualified charitable distribution. Um, just a couple notes that I want to make is I mentioned that currently you have to be 70 years of age or older in order to do a qualified charitable distribution. Qualified charitable distributions do satisfy required minimum distribution if you have those. And currently the year that you have to start taking required minimum distributions is 73. So if you've got to take them and you don't necessarily need the money, then a qualified charitable distribution is an excellent way that you can satisfy that requirement and give to a charity of your choice who can really use the assets, and not have to have a tax liability, because we'll talk about other issues with tax liabilities when it comes to paying Medicare premiums. You know, when you're having to take a distribution of $25,000 a year from your IRA, if number one, if you don't do anything with it, you're going to pay taxes on it, but it could also bump you up into the next the next rate for Medicare premiums. And I've talked to a lot of donors where this is a major issue. And currently, the maximum amount for a per person for each year, you can do up to $105,000. So $105,000 per individual per year for qualified charitable distributions. So now I'm going to switch over to talk about required minimum distributions, which is a federal regulation that states that anybody over the age of 73 has got to start taking a distribution from their retirement account. And I'm going to give you an example of the calculation, because it's a calculation that is done, and the best way to understand it is to follow through an example. So let's take the year 2025, our current year, and let's say our individual is 73 years old. And the one piece of the calculation is you've got to go to the IRS life expectancy table to find out what the life expectancy factor is for a given age. And that factor for the age of 73 is 26.5. And so you also need to have the balance, the cumulative balance of all your not yet taxed retirement assets at the end of the previous year. So December 31st of 2024, in my example, if my total retirement assets, and I'm not talking about Roth IRAs, I'm talking about assets that have not yet been taxed, my total amount was $500,000. So the calculation is this: you take $500,000, the balance, divide it by the expectancy factor, which is 26.5, and the required minimum distribution for this individual is $18,868. So that's a significant amount of extra taxes that that person will have to pay, and it could bump them up into the next bracket for Medicare premiums. So if they don't need that money, my suggestion might be that they consider sending that at least that 18,000, that required minimum distribution amount, to a charity of their choice, so that they can satisfy the required minimum distribution, but also not have to pay any taxes.
That's a wonderful explanation. I'm a trained English teacher, so I don't do math, but your math was really clear, and I liked that you gave an example. And I just want to ask, for that $18,868 that person in your example is required to take, can they give it to multiple charities as long as the charities meet the requirements of being a 501c3, or does the whole amount have to go to one entity?
That is an excellent question. It can go to multiple charities, but
Right.
you've got what the federal government is going to be looking at is that you're taking at least $18,868 out of your total retirement assets that have not been taxed. But you can split that $18,000 figure up into multiple charities.
Right.
And then you can also, because they're 73, they can take more out and
Right.
and give up to $105,000.
Right. Wonderful. Okay. I know we could go on like this for a while, but we have two more people waiting in the wings who are
Yep.
Also smart and interesting. So last question. For people interested in making a planned gift to the trust and to other organizations that they're passionate about, what are next steps?
The first thing I would suggest is every individual ought to make a list of your assets. And this is just, making a list of your bank accounts, your brokerage accounts, insurance policies, retirement accounts, stock portfolios. Maybe you have a valuable art collection, your automobiles, any real estate, land. Just make a list of all of your assets, and then take a look and think about how you want those assets distributed upon your death. Some will make sense that they go to your children, or if you have a surviving spouse and so forth. But some you may want to support the Shenandoah National Park, or your local church or school or whatever. But the point is, think about it, because you don't want somebody else deciding those things. You want to decide those things. And then once you've made a list of your assets, thought about it, talk to a professional, talk to a really qualified attorney who works with trusts and estates and estate planning, or an accountant or an investment advisor who is well versed in these types of plans. The next thing I would do is talk to your family. I worked with a lot of attorneys who suggested that individuals write a simple letter explaining why they're giving this to this person or this to this organization, so that the families understand the estate plan. And I think that's a very important thing. Believe it or not, a lot of families don't share that information. And then lastly is, if you have a charitable component to your estate plan, inform the charities. Make sure you talk to the charities, because I have seen too many times from the charity's point of view where you can't you can't uphold the donor's wishes and intentions for various reasons. And so make sure that you make that communication.
Wonderful. And I do want to note that the trust does have a form in which you can declare that intention. It is non-binding, and we will have it available for anybody who asks, and I'll tell you more about that in our follow-up email. Rhonda, I know you could go for longer, but for now we're going to have to stop. Thank you so much for this and for explaining things so clearly. We're really grateful. And now I would like to bring our next guest, Geoff Close, who's going to talk about one of the planned giving options that Rhonda told us about, land donations. Geoff is a retired private wealth advisor with over 40 years of experience at Morgan Stanley. And now that he's retired, he's the founder and philanthropic advisor at Impact Philanthropy Partners, which provides pro bono advice to nonprofits and their constituents. Geoff is a proud University of Virginia graduate with a BA in economics, and now he lives in Charlottesville. He's a very active member of our community, a volunteer and a board member of local and regional organizations, including volunteering for the trust, and we're very grateful. Welcome, Geoff. I can't wait to hear this story. I know it's a really interesting one in which you helped a family with a land donation in a creative way and also in a tax smart way. And it benefited everybody. Everybody got what they wanted. So your goal when you were at Morgan Stanley is to help your clients use planned giving strategies as a means of wealth preservation to secure their family and their family wealth, protect the next generation, but also make a philanthropic impact. And all of those things are possible. So tell us about this case study of yours. Land donation is somewhat of a new concept for us in terms of planned giving. So we're eager to hear the story.
So anyway, Anna, I'm going to be combining two topics. One is the land and the other is the vehicle that Rhonda discussed, a charitable gift annuity.
Perfect.
So let me explain the situation. We were approached by a very crusty old 70-year-old dairy farmer who couldn't wait to stop getting up at 4 o'clock in the morning to milk the cows. He had a place in Florida that he wanted to spend the next chapter of his life there, and just couldn't wait to get out from under the dairy farm. However, now the dairy farm had been in the family several generations, and they had two sons who wanted to keep the dairy farm in the family. Art, the patriarch, wanted to just, let's take the property, give it to a developer, and that's it. When I had moved to the town, we had 5 dairy farms. This was unfortunately the last dairy farm in the town. The town and the land trust wanted to do everything they could to maintain the dairy farm in the township in operation. So what we did, Art, the dairy farmer, kept talking about, oh, my land is my 401k. My land is my 401k. It's my retirement plan. So I'm thinking, okay, what can we do? Well, we can't replicate a 401k, but we could replicate a defined benefit pension fund. So would he be interested in a pension fund? Well, yeah, okay. So what we worked with him to do was to bifurcate. Don't like using legal terms. Bifurcate means split. We split the development rights off of the property. So you have the dairy farm, you have the development rights. The development rights have a monetary value. And what we ended up doing was we had an appraisal of the development rights. The development rights were then gifted to the land trust for the benefit of a charitable gift annuity. So Art ended up getting a guaranteed fixed payment for his lifetime and his wife's lifetime. He got a significant charitable deduction for not the total value, but the present value of the development rights. The sons, the adult sons, were able to purchase the dairy farm without the development rights attached to it. So they bought it at a discount from Dad. Dad was perfectly happy. He had cash, he had an income cash flow, able to go down to Florida and work on the only thing that he would do was wake up at 4 o'clock in the morning now so he could get on the golf course by 6 o'clock. Okay, so what do we have here? Charitable gift annuity. Rhonda didn't go into it as much of a detail. What it is it's a contract. It looks very similar to a commercial annuity, but there's a major difference between a commercial annuity and a charitable gift annuity. The commercial annuity ends up, you have to pay cash for it. So if you have appreciated assets, you have to sell the assets, pay the capital gains tax, and then give Pacific Life a check where they'll give you an annuity. A commercial annuity can take in appreciated property, be it the development rights on the dairy farm, be it stock, be it commercial property, and at that point, the nonprofit organization then liquidates it in their taxpayer ID number, which means that they are paying no tax on it. The commercial annuity will pay you only a return of principal and income. With the charitable gift annuity, you have a tax favored cash flow where a portion of the property is actually, you're spreading the capital gain out over your life expectancy as opposed to paying it once right there, and the unpaid balance continues to accrue investment performance on that. So, and it's a guaranteed fixed amount. Interest rates go up, interest rates go down, doesn't matter, fixed amount. Stock market goes up, stock market goes down, doesn't matter, it's a fixed amount. At the maturity of the charitable gift annuity, at the passing of the surviving spouse, what's left, what's called the residuum, ends up reverting to the nonprofit issuing organization, which can be used toward an endowment program for long-term sustainability of the organization. So in this situation, Art got what he wanted, which was out from under milking the cows at 4 o'clock in the morning, got out with a very nice situation where he ended up having his sons buy the dairy operation, the land, contributing the development rights to the land trust. The land trust gave Art what looked like a pension, which was a quarterly distribution for the rest of his life, the rest of his wife's life. Looks very similar to a corporate pension fund. Did not pay any taxes on the contribution of the development rights, actually used the contribution of the development rights to shelter some of the gain that he was accruing from the sale of the dairy farm from his sons. So ends up, there's no tax, no tax, no tax, no tax, no tax. At the end, the land trust gets a what's left, and as Anna's introduced me, everybody got what they want. The sons got the dairy farm, and Art got his secure retirement.
That's a beautiful story. And I like the way you explained it. I do understand what you and Rhonda are saying, that charitable gift annuities and other kinds of annuities are a complex topic. So it is a topic that we're going to circle back to you about, maybe in a future blog post. But for this specific example, I just want to reiterate what you told me earlier, that this process took about 2 years. Is that right?
No, I took 10 minutes to explain it, but the whole process took about 2 years to unwind.
Right.
But yeah, what we ended up doing was the land trust ended up giving the development rights to the state of New Jersey, which under their farmland preservation program, which monetized it for the benefit of the land trust to be able to make distributions to Art the farmer.
Yeah, I mean, it was a lot of hard work. You worked with the Community Foundation of New Jersey. You worked over 2 years, but like we said, everybody got what they wanted, and there were great tax benefits for everybody. So I think that this is a topic we want to learn more about in the future. And I thank you for bringing it to us and sharing your expertise. Everybody listening, we will be bringing Jeff back. He will be continuing to volunteer for the trust and share his expertise with us. Thank you, Jeff, for tonight.
And let me also make the offer too, that if any of your constituents have an opportunity that they would like to discuss or explore, the good news is I listened to my own advice when I was a wealth advisor with Morgan Stanley. So I'm able to offer this on a pro bono basis, both to the Shenandoah Trust and to your constituents too.
That's beautiful. And we will actually be talking about more in the future as we structure a way for you to share and continue to volunteer. So thank you for that generosity tonight and in an ongoing way. There are some complexities around land. And so now I'm going to bring our next expert onto the mix. Thanks again, Jeff, and introduce you to my wonderful colleague, Elizabeth Mizell. Beth joined our staff in February 2024. Happy year anniversary, Beth, as the manager of our Good Neighbors program. Beth spent her entire career in the conservation realm. She started in her college years as an interpretive naturalist in her home state of Indiana. And then after school, she was a land steward with the Nature Conservancy for over 14 years. And most recently, some of you may know her as the executive director of the Blue Ridge Prism. And now we get to work with her. Welcome, Beth. Thank you for being here. Start us off by telling us, what is the Good Neighbors program? Why now? How can it impact our conservation of lands, public and private?
Sure. Well, thank you, Anna, for that lovely introduction. And I've just been delighted to hear from Rhonda and Jeff, and to be able to kind of put a bow on this conversation and how you can impact not only the park, but also the trust through a gift of land. So I have a few slides I'm going to tee up for us. So bear with me just a second. I'm still learning how to use Teams. So what is the Good Neighbors program? Let me get this playing. Okay. Anna, can you confirm that you can see that? Okay. Okay, so what is the Good Neighbors program? Anna mentioned that I started in February of 2024, and so did the Good Neighbors program. So the Good Neighbors program is a land conservation program focused on working in the borderlands around Shenandoah National Park. So it's the land conservation arm of the Shenandoah National Park Trust. The Shenandoah National Park Trust has been the philanthropic partner of Shenandoah National Park, but our focus has been really within the park boundary, supporting staff positions, forest health projects, trout monitoring and research, education and outreach, interactions with the public, overlook clearings and maintenance. So this is a very new territory for the trust, thinking about, well, what's happening outside of the park boundary, and we know that what happens outside of the park boundary impacts what's happening in the park. So just a little bit more background about Shenandoah and why were interested in this Good Neighbors program and land conservation. You'll see the little map of Shenandoah National Park, and then the location of the park in the state of Virginia along the Blue Ridge Mountains. And one thing that you might notice about this park is it is long and it is skinny. It's almost just over 200,000 acres. It's stretched 105 miles in length, so that's Skyline Drive. And the park manages over 800 miles of border. That's mostly shared with lands that are in private ownership. And I was doing some work in GIS recently, and I got this really cool layer to look at the different lands around the park, and was able to calculate that just over 2,000 individual parcels touch the park boundary. And there are a lot of small parcels and there are a lot of big parcels, but there's more smaller parcels than bigger parcels. Because land is turning over very quickly along the park boundary. The park's proximity to Northern Virginia and DC, people want to come here for a second home. They want to move out of the city, or maybe they're commuting to DC, and but they're not living in the DC area. So it's a very attractive area. And who doesn't love living around the Blue Ridge Mountains? It's beautiful. The park is beautiful. Our region is beautiful. Anna mentioned I grew up in Indiana. I grew up in the hilly part of Indiana, in the southern part of the state that was unglaciated. But the mountains, since moving to Virginia, I find the mountains really peaceful and comforting. And I really like being in this part of the world. And so do a lot of other people. And I'll also mention that the park is also the headwaters of the Rapidan and Rappahannock rivers on the east side of the Blue Ridge Mountains, and then also as part of the Shenandoah watershed on the west side in the valley, and all this flows into the Chesapeake Bay. So it's a really important area for water quantity and water quality. Go to my next slide here for you. So I mentioned what happens outside of the park boundaries affects what's inside of the park and vice versa. And this geographic boundary that us humans put on the land, it is arbitrary to the plants, the wildlife, invasive species, water, etc. And thinking about what's might happen in 30, 40, 50 years or 100 years, a healthy park in the future is dependent upon the health of the land, the forest, and the waters that surround the park. The wildlife that use the park, the charismatic wildlife that we love, the black bears and the bobcats and the migratory birds, all of these creatures, they depend on the park's connection to other natural areas throughout the region in Virginia. So that the Good Neighbors program and thinking about working along the borderlands ensures the park's connectivity to the rest of Virginia. So the Good Neighbors program, we're working outside of the park boundary to protect the wild Shenandoah landscapes that we love. And the Good Neighbors program uses multiple strategies to accomplish this goal, and one of which is protecting strategic parcels of land that are adjacent to the park. And a gift of land supports Wild Shenandoah, which is one of the Trust's 4 pillars of our work, Wild Shenandoah, that protects and restores the park's natural resources. So protecting land fits into Wild Shenandoah, and it restores and protects the park's natural resources. So there are different ways that you can leave a legacy to specifically benefit the park. First, it can be a gift to the Edge Fund. And the Edge Fund is a dedicated funding pot of money. It's restricted, and it's dedicated for land conservation in and around Shenandoah National Park. So funding from the Edge Fund, it supports the forest health projects like the combating the woolly adelgid little tiny creature that's impacting our hemlocks in the park, or emerald ash borer impacting the white ash trees that are in the canopy of the forest. It supports land acquisition and other projects like that. So, so you can leave a bequest to the Edge Fund. Another way that you can help support the park is through fee simple bequests of land. And so I'm pulling in some of this legalese, but what is fee simple? Fee simple means that the owner is entitled to the entire property. It means that you own your entire property and you are transferring that entire bundle to another owner. So I'll just read you the definition because I feel like I'm bungling it. Fee simple is in which the owner is entitled to the entire property with the unconditional power of disposition during their life, and they're descending to their heirs and legal representatives upon their death, intestate. So that just means it's all of the land. It's not an easement. It's not a parcel interest. It's the entire property. So why, so I'll touch on, there are other gifts of other real property that maybe it doesn't actually touch the park, but maybe it's your residential home or land that you want to leave as a bequest. That could benefit the trust and support other land conservation work. And then there are those creative solutions that Jeff beautifully illustrated for us. And I remember the first time I met Jeff at a Wine on the Rooftop, we talked about that, and I was just, my mind was blown by the complexity and the creativity. And so let us be your thinking partner, when you're thinking about a bequest of land. Let's talk. So just to coming back to the fee simple bequest of land, like you own a parcel of land and you want to leave it to the trust in your estate. So you might have some questions, and I'll touch on a few, but why leave a gift to the trust instead of directly to Shenandoah National Park or NPS? Well, as a philanthropic partner of the park, the trust is best equipped to manage those types of gifts. And then we can take that gift and steward it into the park ownership. The Park Service, they require specific reviews of the land prior to acceptance of a land donation, and the trust is in a better position to be able to help the park do that, to conduct surveys or title searches. They do an environmental assessment, so we can help do those things and help the park do those things. And then also, when it can take several years for a parcel of land to even get into the park's hands. It could be 3 years or more, depending on the complexity of the land donation. So we are the better organization, and then we can honor your wishes and steward that land into park ownership. So what is our process? It's pretty simple, and I think Anna touched on that, and that we have a form that you can tell us that this is what you're doing. But we would really like to talk to you if you're thinking about leaving a gift of land to the trust. We would really like to talk to you as you're making your estate plans. We can talk about your intent so we understand your wishes. We can take a look at the land, walk the land with you, and help to evaluate it for donation to the park. Help with the bequest form, and that's it. And again, all of our documentation is non-binding. So if your life circumstances change or you change your mind, that's okay. So one question that we do get is how do we guarantee that this bequest will become part of the park? So we're ethically and legally obligated to honor your estate plan to the best of our abilities. And if you speak to us on the front end, we can, again, evaluate the parcel, speak to the park about their interests. Like, does this make sense that this particular parcel come into park ownership? And then we can clear any future barriers now to prepare a bequest for future donation. And all of those steps are optional, but they do help clear the way. So it's a lot easier in the future when we're stewarding that property into Park Service ownership. And then the benefits to this, your estate or your heirs are just similar to what we were talking about earlier. There are donations to qualified charitable organizations or a deductible from your estate, and it minimizes a tax burden for your heirs. And that's not my area of expertise, so I'm just going to leave it at those simple statements about your taxes. But I would like to offer an example. About just bequests, and I've recently met a beautiful couple, and talking with them more about their wishes, and they love the park, and they love the land, and they already see their land as part of the park, and so working with us just makes it so. And I encourage you, even if you don't leave a bequest of land to us, to think about your future and what you want to have happen to your land, and hopefully maybe we can talk about that as well. So, and then I have one last slide I want to share, and then I'll hand this back off to Anna. We're talking about estate planning and leaving land in a bequest. And but you might be thinking, well, I would like to do something about my land now. And this is where the trust can also be. We accept donations of land to benefit the park. And there's a few ways that we can go about doing that. Just a fee simple land donation. We can take about a year for that to happen, and we can work with you on that. A bargain sale, which means you sell the property lower than the appraised value, and then you get to take a deduction on the difference. A retained life estate. It's a more complex vehicle, but we can certainly explore that with you. And that means you get to live on the property until you are not on the property anymore. And then that automatically transfers to the trust. And there are certain tax benefits associated with that. Again, this is not the tax implications are not my area of expertise. And then lastly, there are conservation easements. The trust, we do not purchase or accept donations of conservation easements. However, we have wonderful partners that work all around the park that do. And so we can make those introductions and help you if that is something that you would wish to protect your land in perpetuity. And also there are tax implications, benefits. And I'll just lastly, to wrap up, I mentioned some of the tax benefits. And one thing about Virginia that is special is Virginia has an extra tax benefit to support donations of land or easements to charitable organizations, and that's called the Virginia Land Preservation Tax Credit. So you would get your federal tax benefit, your state tax benefit, and then you get an extra tax benefit from the state of Virginia. And that tax credit, you can take that in the form of your tax credit, or you can sell the credits in an open market and pocket the cash. So those are all for referring back to if you wanted to donate your land to the trust now. And I'm happy to talk about that more if anybody would like to reach out to me after this program. So Anna, I think I've wrapped up my section.
You
and
have, with a beautiful bow.
Hand it back off to you and for the Q&A, I guess. So
Yes,
thank you.
We do have time for Q&A, and I just want to reiterate what Beth said, that Rhonda and Jeff and Beth are here, and even if you have follow-up questions after the program, they are here to answer them. They also just want me to remind you that we are not lawyers or we can't give tax or legal advice, so we can help guide you, and then you can go to your qualified expert and we will work with those people as well. So we've had a couple of people when they registered submit questions to you, Jeff, Rhonda, and Beth. So we'll go over those first, but if you've got any more, please put them in the chat. We are monitoring the chat, but I'll just start with some of the ones that were pre-submitted. Rhonda, why don't you take this one? Are there any special considerations that donors who live outside of Virginia need to know about in terms of planned giving?
Not that that I covered. Now, I think the specific land credit that Beth talked about is probably a consideration for only Virginia residents. But in terms of making qualified charitable distributions, in terms of making bequests, no, that you can live anywhere and send it to the Shenandoah Park in the state of Virginia.
That's great. Wonderful. Another registrant said, how should we communicate our intentions to the Shenandoah National Park Trust? We did cover that. I will remind you of our non-binding agreement, which I can send to anybody who wishes it. And let's see, I heard another registrant said, I heard it was better to designate charities rather than my children as the beneficiaries of my IRAs and retirement accounts. Is this true? And if so, why? Rhonda, why don't you tackle that one too? There is a lot of confusion surrounding these kinds of decisions, and you have been very clear that we should figure out what we want and write it down and communicate it both to our charities and to our families. But protecting our families and making sure our heirs are taken care of is very important to everyone. So I can understand the confusion around this particular question.
Yep, I do too. So this is why you get your list of assets, and you have to with retirement assets, you have to divide them into those that have already been taxed, like a Roth IRA, versus those that have never been taxed, like your 401k, your traditional IRA. Those assets that have never been taxed, if you leave those to your children, they will have to take those minimum required distributions as soon as they inherit them, and they will pay taxes on them. As opposed, so I have always told my donors that if you have a charitable component to your estate plan, that you want to support the Shenandoah Trust, then think about those retirement assets that have never been taxed, because you're going to get more bang for your buck for giving those assets to the charity where there's not a taxable situation.
Wow.
That's the reason why. And I'm happy to go into a lot more detail about that, but you've got to think about those assets that have never been taxed. They are going to be taxed at some point. You never get rid of tax, you just push it down the road, unless you give those assets to a charity.
Well said. Thank you. And I'm sure that some of our listeners will have follow-up questions for you after this program. So stay tuned. Jeff, you gave us a wonderful case study about a working dairy farm, and we learned about the complexities involved with getting everybody what they wanted. It's a creative strategy, but does this kind of creative strategy work if it's just open land, and how would it be different? This is something Beth touched on as well, but I wanted to get your financial planner point of view, since you have structured deals like this.
There's no real difference between that. There's different part between farmland preservation and open space preservation, but you can go through and get those credits that way. And yes, if you just have open land, you can gift the land with the development rights associated with it, and the development rights would be extinguished when you give it to the Shenandoah Trust or a regular land trust.
Wow. There's a lot of layers here, Jeff. So I imagine there will be follow-up questions for you after this program as well. We have a listener question just submitted, and Beth touched on this. So Beth, you might want to just explain it a little bit further. What if your land doesn't touch the park, but is adjacent? So I'm thinking that means near, but not touching.
Okay, sorry, I had to find my microphone thing to turn on. It depends.
Ah.
It depends. And this is where we would want to understand better, like where your land is, proximity to the park, and then also start to look at, well, what's around it? You know, is this an important area along the park boundary? Are there rare plants and animals, or is it critical for the park? Does it fill in a gap along the park boundary? And how far away is it the park? Are there other parcels between your parcel and the park that we could cultivate for donation or acquisition? So it does connect to the park. So it's helpful to have that evaluation process. If there are parcels that were to be left in a bequest to the trust that were well outside of the park area for, 15 acres and, on the other side of Waynesboro, for example, those would be treated very differently than trying to usher it into the park ownership, because it just doesn't, it may have some conservation value. It certainly has emotional value and value to that landscape, but it may not be the best use of the land to transfer it into the park. So maybe in that case, maybe a conservation easement would be more appropriate to protect the land for the longer term in perpetuity. So it's never developed, but it would protect it, but it just wouldn't become part of the park. So it's a much larger conversation, and this is part of my job at the trust. When I work with landowners who want to donate land, we go through this evaluation process, and I'm in GIS. I'm looking at state natural heritage resources. I'm talking to the park. I'm providing them detailed reports on the land and what I'm seeing in the condition of the land, and if the forest is healthy. And then we can make a plan from that together.
Wonderful.
I hope that answers your question, Joanne.
It was a very concise answer and multi-layered, but very clear. And we're non-experts here, those of us who are listening. So thank you, Beth. And I have to say, the three of you, Jeff, Beth, and Rhonda, sharing your expertise with us tonight and your experience it's really special that you've are giving to us in this way. And Beth, it's amazing what you've accomplished in the last year that you've been at the trust. We look forward to seeing more about what you're going to do. And we look forward to continuing the conversation with you, Rhonda, and with you, Jeff. So thank you. There are not enough ways for me to say thank you. For those of us who are here listening, we will be sending out a follow-up email with lots of information in it and ways to contact us, ways to be in touch. Please stay in touch. And I just want to say thank you to all of our donors, because we would not be able to do the work that we do. We would not exist without you. So thank you for being here, and we will see you all soon. Thanks again, guys. Bye.
Thank you.
Thanks,
Bye,
guys.
everyone.
Bye.